As we look at the screens right now on Thursday, April 23, 2026, Navitas Semiconductor is trading at $17.53, experiencing an intraday cooling of about 5.1% after one of the most explosive multi-day runs we have seen in the specialty chip sector this year. If you were watching the tickers yesterday, you saw this name screaming higher, finishing near $18.47, a massive move from where it sat just weeks ago in the single digits. This morning, we are seeing the classic tug-of-war between momentum traders taking their wins and institutional players trying to decide if this new price floor is sustainable or just a temporary peak driven by the frenzy surrounding power efficiency in the next generation of data centers. The reality of Navitas right now is far more complex than the simple AI play narrative that has been making the rounds on social media and retail trading boards. While the market expected a slow, steady recovery for small-cap semiconductor firms, the reality is that Navitas has suddenly positioned itself at the literal bottleneck of the artificial intelligence build-out. We are not just talking about the chips that do the thinking, like an Nvidia stock play, but the hardware that manages the sheer, ungodly amount of electricity these systems consume. Most investors were looking at this as a niche mobile charger company, but the reality is that their recent work with high-voltage platforms has turned them into a vital infrastructure provider. This contrast between being a phone charger company and an AI power backbone is exactly why the stock has doubled in such a short window, catching the short sellers completely off guard. When you look at the recent movement, the volume is what really tells the story. We have seen days with over 80 million shares changing hands, which is a massive departure from its quiet history. This isn't just retail enthusiasm on the Robinhood app, this is institutional accumulation. When a stock like NVTS gaps up from $13 to $16 and then holds those levels, it suggests that professional desks are looking at the long-term shift towards gallium nitride and silicon carbide. These materials are becoming the gold standard for efficiency, and as the grid struggles to keep up with the demands of massive server farms, the efficiency gains Navitas offers are no longer optional. They are mandatory. If you were doing your own online investing or using investment sites to track these trends, you've likely noticed that the power management subsector is finally having its moment in the sun after years of being overshadowed by the logic chip giants. The general belief was that Navitas would struggle to move beyond its consumer electronics roots, but their recent demonstration at the major industry trade shows proved otherwise. They showed off a power delivery board that effectively cuts out the middleman in electricity conversion, which is a massive deal for any company trying to lower their cooling costs and electricity bills. This is where the tension lies. The market narrative says small-cap semis are too risky in a high-interest rate environment, but the industrial reality says we cannot build the future of computing with the specific technology Navitas holds the patents for. It's a classic case of the underlying business fundamentals finally forcing the hand of a skeptical market. For those using a self-investing approach through an individual brokerage or a SoFi active investing account, this kind of volatility is a double-edged sword, but it highlights why keeping an eye on technical shifts in the hardware stack is so critical. I want to hear from you on this. Comment below with how many shares of Navitas you are currently holding, or if you think this recent spike is a sell the news event before their earnings report on May 5th. Let's break down the actual business for a second, because understanding the what explains the why behind these wild swings. Navitas Semiconductor specializes in power semiconductors. Unlike traditional chips made of silicon, they use wide bandgap materials like gallium nitride, or GaN, and silicon carbide, or SiC. These materials allow electricity to move faster and with less heat loss. Think of it like the difference between water moving through a rusted old pipe versus a high-pressure frictionless tube. In the past, this was great for making your laptop charger smaller. Today, it's what allows an electric vehicle to charge faster and a data center to cram more processing power into the same physical space without melting. Their business model has shifted from selling small components for consumer gadgets to providing entire power systems for industrial applications, which carries much higher margins in longer-term contracts. Looking back at their previous financial reports, the company has had a rocky road, which is why the stock was beat down for so long. They've dealt with negative net margins and the typical growing pains a hardware startup scaling into a global player. However, the recent appointment of industry veterans to their board, specifically people with deep ties to the heavyweights like Broadcom, signals that the company is maturing. This is the kind of detail that doesn't always show up in a quick search on a Fidelity mobile app or a standard interactive brokers platform, but it's what big money investors look for when they want to see if a company is ready for the big leagues. It's the transition from a growth-at-all-costs startup to a strategic infrastructure partner. In the current macro environment, the pressure on the semiconductor sector is intense. We've seen some cooling in consumer demand, which initially hurt Navitas, but the pivot to high-power markets has acted as a shield. Institutional activity shows that while some funds are rotating out of the high-flying software names, they are looking for picks and shovels plays in the hardware space. Navitas fits that description perfectly. They aren't trying to outcalculate the big names. They are trying to be the ones who keep the lights on for them.
If you're managing your own portfolio through a Schwab Intelligent Portfolio setup or a Fidelity brokerage account, you know that diversifying into these specialized hardware niches is often how you capture growth that isn't tied strictly to the broader index movements. Moving into the future outlook, the catalysts are lining up, but so are the risks. The big date on the calendar is May 5th, when they report their first quarter earnings. The market is expecting them to prove that the recent technology partnerships are actually translating into revenue. If they beat expectations and raise their guidance for the rest of 2026, this $17 range might just be the new baseline. However, if the reality of their cash burn or a delay in industrial adoption hits the headlines, the pullback could be just as sharp as the rally. The reality of semiconductor manufacturing is that it is capital intensive and subject to global supply chain whims. Even the best tech can be sidelined by a shortage of raw materials or a sudden shift in trade policy. When we compare the expectation of a volatile, speculative small-cap stock with the reality of a company that is becoming essential to the AI power grid, the valuation gap starts to make sense. Investors are no longer just betting on a maybe, they're hedging against a future where power efficiency is the most valuable commodity in the tech world. Whether you are using the Interactive Brokers trading tools to play the daily swings, or you're a long-term holder in a Fidelity wealth management plan, the narrative here has shifted permanently. Navitas is no longer just a component maker, it is a case study in how specialized hardware can disrupt an entire industry's expectations. To wrap this up, the central insight here is that the recent price action in Navitas Semiconductor isn't just meme energy or a random spike. It is the market finally pricing in the strategic importance of power management in a world that is increasingly thirsty for electricity. We saw the stock touch incredible highs this week, and while today's slight dip to $17.53 might look like a retreat, it is more likely a period of consolidation as the market digests the massive gains. The contrast between what people thought Navitas was, a mobile accessory play, and what it actually is, an AI infrastructure essential, has created a massive valuation shift. Keep a close eye on that May 5th earnings call, as that will be the moment where the reality of their balance sheet either confirms the expectation of the bulls or gives the bears the opening they've been waiting for. Whether you're trading on the Robinhood app or managing a complex set of Fidelity ETFs, this is a name that demands your attention as the hardware cycle continues to evolve. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.